Good afternoon, everyone. My name is Matt Gordillo. I'm partner in financial advisors, Park Edge Advisors. I'm joined by Gavin Gowecki, portfolio manager, and Rich Lowry, partner and chief investment officer. Hi, guys.
Hey,
Hey
Matt.
Matt, how you doing? Hello,
Good.
everyone.
Before we begin, a quick word from our sponsors. Okay. Thanks, Gavin and Rich. Sorry I missed you last month, and I'm glad to be back learning more about the markets from both you gentlemen.
Great.
Good to have you back.
Gavin, as always, we've got a lot going on in the markets, but we produce this market insights piece we send out to our clients and colleagues. Maybe you could bring us up to speed from last month, July, to the beginning of August, and then we'll touch base on some recent news that came up here today, in fact. But if you could bring us up to speed from the beginning of last month, that'd be helpful.
Sure. From July to August, our regime tracking is stayed in a reflation quad 2. Quad 1 and quad 2 are risk on, quad 3 and quad 4 are risk off. And during the transition from July and August, we did see a few of our shorter term, most adaptive risk management signals start to show a little bit of a warning sign. And that's been the case on and off. And I think it's important to kind of talk through that and say, like, we do have an eye on some things that would want to get us to be a little bit more of a risk off posture. So for now, we're seeing a risk on environment continue. I think today's news is very interesting regarding that Rich will get into a little bit more. But that's the update from July into August.
Okay, so risk on going into August.
Only thing I would add to that is both times it's been credit spreads breaking out from bearish to bullish. In a risk on environment, you want credit spreads to be stable to down. That's a sign of a risk appetite. If credit spreads start breaking out to the upside, that market is telling us they're more concerned about risk. We pay attention to that. That adjusts, the dominant regime. And both times they didn't sustain. So, we had kind of a brief challenge from what looked like the emergence of quad 3 that didn't sustain. Both times it had to do with credit spreads. And we suspect that in some measure is due to the massive amount of issuance that's expected to fund the AI capital spending boom that's going on. There's a relatively inelastic pool of capital out there, and not only is the Treasury a big actor in it, issuing bonds, but now the biggest companies in corporate America are picking up issuance. We saw from one of our research partners, 42 Macro, did a deep dive on whether or not that kind of demand for issuance is any different in signal terms from just credit spreads, rising because of a perceived risk-off environment, and their conclusion was it's no different. So, bottom line is, we in addition to currency volatility, which we've called out in prior issues of Market Insights, bond volatility, and credit spreads, those are kind of the three main things that if we saw those change together, that would help us confirm that it may be a risk-off environment. But right now we're not there yet.
I see. So we have had some moments in time of some risk-off scenarios, but still have not been confirmed. And speaking of issuance, the Treasury had a big announcement today, Rich, and being our Fed and Treasury expert, why don't you explain kind of what the announcement was, what the impact is, and then how it affects kind of what we're doing?
Yeah. So the announcement today is they not only increase, but double the size of the Treasury buyback. So every quarter, which we've talked about on prior sessions, they issue the quarterly refunding announcement. And that says, here's the borrowing needs for the Treasury. And then that's followed up 2 days later by a schedule of composition. Here are the bonds that we're going to sell in order to finance, the needs. they have had in place a buyback. I want to say it goes back at least a year, if not two. That allows them to buy back what they call off the run bonds. You know, a 30-year bond that's been selling in the marketplace for 20 years is now a 10-year bond, but that's not the active bond. That has no liquidity, trades at a discount, the yield is higher. So by them increasing the size of the buyback, it's an effort to kind of cap rates to the upside. And there's been a sizable move in long-term rates. This is seen as an attempt that, okay, the Fed doesn't want to see long rates go any higher. They don't really have many tools available. And this is one of the tools that they do have, is to increase the buybacks. And it's as much about the signaling mechanism as it is about, you know, the absolute size that they're going to buy back. It's a strong signal that the Treasury or the administration doesn't want to see rates go, you know, higher than today. You know, that's causing a big reaction across all of global macro. You're seeing it in rates themselves. You're seeing it in gold. And the question is, what happens, you know, from here? So there's a lot of talk about, you know, the Fed and the Treasury being independent. I personally, based on my prior experience doing, you know, economic advising and economic policy advocacy, do not think for 1 second the Fed and Treasury are independent. Full disclosure, that doesn't have to be the opinion of Park Edge Advisors, but that's my personal opinion.
Rich Lowry's opinion, right?
So I would suspect that they've already like mapped this out.
Yeah.
If the Fed were truly independent, we will know that because Kevin Warsh and the Fed will come out and say, hey, we liked it when long rates were going up and tightening financial conditions. That was doing some of the work for the Fed. And Warsh's whole change of perspective about the Fed is, instead of having a world where the Fed is a central actor and markets all over the world only want to know what the Fed is doing, he wants to pull the Fed out of that and say, no, let's have a natural market response and then let it be up to the Fed to observe what market signals are out there. I support that kind of change at the Fed. I think that's the way it should be. If they really are independent, Warsh could easily announce, okay, if the Fed's going to be buying bonds on the long end, then we're just going to sell bonds out of our portfolio to counteract that. And the Fed could stamp that out and not only totally neutralize the Treasury's impact, but reverse it. I mean, they have a much bigger balance sheet where they could sell mortgage-backed securities outright. They could sell 10-year bonds, 20-year bonds, 30-year bonds out of their portfolio and totally reverse that impact. We'll see if that happens. My guess is it doesn't. And what it means is they've increased the amount of buyback, but they have not changed the overall amount of issuance. So if you're going to buy on this end, you got to come up with the money to do that because they're not changing the size of the issuance. It basically means they're going to sell more T-bills. And the next test of independence is the Fed under, going back to Janet Yellen, Yellen, Powell, and now Warsh have been relying very heavily on issuing T-bills to finance, you know, government operations. So much so that periodically the repo market has malfunctioned. If bills are plentiful, why would anyone transact in the repo market if you can just buy bills? It's when bills are scarce that keeps, you know, the repo market, you know, functioning properly. To alleviate the strain in repo markets, the Fed came out with an acronym, RMOP, Reserve Management Operating Procedure or Portfolio, whatever. As we've said numerous times before, due to the structural supply-demand mismatch in the Treasury market, there just aren't enough buyers for the amount of Treasuries that the Treasury has to issue. The Fed's the only entity out there with a balance sheet big enough and flexible enough to step in and close the gap. So when the Treasury issued so many bills, they came up with the RMOP program. Uh, Based on the size of the increase in this buyback program, if they have to match that off with greater bill issuance, that might put pressure on the Fed to say, well, we're going to have to increase the size of the RMOP, or maybe even come up with a new acronym. But it's basically the same thing at the end of the day. There aren't enough buyers at these yields for the amount of treasuries that the Treasury has to sell. The Fed is probably going to be counted on to step in and fill the void. And it may be a step removed or an indirect way, but the Fed will print bank reserves in order to close the gap. So we're getting kind of a noisy reaction to this today, and it'll be a matter of how does this play out? They haven't issued the extra bills yet, so let's see what that does. Does it do something to the repo market? Does that cause the Fed to react? And all of this is coming on the heels of a massive intervention in the Japanese yen, where the most direct path for Japan to defend the yen would have been just an outright sale of treasuries and then use the dollars to buy yen. Instead, the Treasury stepped in on that and said, oh, no. We don't want you to just outright sell long treasuries. Deposit those with us as collateral. We'll issue dollars against it, and you can support the yen that way. So, I look at this as two big, interventions by the Treasury within a span of a few weeks. It's a signal they don't want to see rates going higher. And probably the reason they don't is a question about what does that do to overall financial stability if rates do climb higher. And then it's a matter of, is it going to last? Let's let a month go by and see, is the market, kind of trusting that, hey, the Treasury is going to step in again. You don't want to be short bonds at this level. Or do they drift higher and cause the Treasury to come out and not only do it again, but do it in even more size? So a lot going on today. But, fortunately for us, I think we're tracking, the right variables across all these markets, where we're looking at not just equity markets, but, volatility in the currency market, volatility in the bond market, credit spreads, foreign currencies, global bond yields. I think we're tuned into the right things, that if this does cause a reaction in either direction, it could be bullish and it could be bearish, depending on other factors. I feel pretty good that we'll be able to track that, phase transition.
Yeah, I think, I know, Gavin, you used the term, hey, it's a messy day today. Maybe you can talk about that, because what I'm hearing is things that the Treasury does affects rates. And I think a lot of people saw, the headlines of these long-term rates going up to north of 5%, which hasn't happened in a while, 5.3 or 1 or something like that. So maybe you could shed some light on how longer term rates and, the recent earnings seasons are impacting things, because there is some relationship between rates and then, earnings and stocks.
Right, sure. It's well known that longer term yields and rates on treasuries, have a direct relationship to valuation for stocks because you can compare one to the other. And I think going into today and today's announcement, so interesting, that the longer end, which is what today's announcement was about, was starting to push up to rates or yields for people at home. To think about it, the 10-year is, up at 4.65%. The 30-year is up towards over 5%, just for people who don't know this stuff all the time. But those levels were starting to push up to a point that would start to, at this particular moment, put a bit of pressure on the valuations of stocks, the S&P 500 as a whole. I think we were talking earlier before we started that there's been a lot of dispersion in the market, meaning all the stocks within the S&P 500 are not just going up and down together. Some stocks are going up, some are going down. But I think the takeaway here is that where yields are important for valuations of stocks. And this earnings season that we just basically got through the majority of ended up being very good, and consensus and analysts took up their estimates again. Uh, Now, keep in mind, I know Rich is probably thinking, now those estimates don't need that. That doesn't mean that those estimates are going to come true. It's just that that is the consensus. And at Park Edge, we want to be aware of what the consensus is pricing and thinking. And so I think today's announcement for me, boots on the ground, just kind of mitigates as of today into tomorrow, that multiple compression for valuations and stocks that could have been starting to happen, and we'll see one day at a time how it plays out from here.
So there are some things there I think you can read between the lines, but Rich, if we were to sit here and say for those at home, the clients and our colleagues, this is interesting stuff about treasuries and higher yields and earnings have been good. So you would think that'd be good for stocks. But things like currency and bond volatility are all things that you've got your eye on. What type of takeaway should the clients have, as they're listening to this and how it relates to their portfolios? What should they be thinking about?
Well, that's a good question. That might be the most important question, on the session today. But to me, it kind of goes back to what we've talked about plenty of times on these, which is that's why we do adaptive risk management. Compared to a traditional buy and hold, you either wouldn't pay any attention to today's news, you wouldn't bother tracking any of the follow-on effects of this. You would hope it works out okay. And if it doesn't, you've already kind of pre-committed to a static risk allocation where you're along for the ride. News like today, if anything, I think expands the range of probable outcomes. There's certainly a bullish case that could come out of this. That would be a cap on long-term rates, avoiding any, pending or threatening multiple contraction that Gavin was talking about. Alleviate some concerns about the treasury market and lead to a positive outcome. If that's the way it evolves, and we would see that with, the dollar not breaking out, it's down today. That keeps the dollar in check. The dollar breaking out is a risk-off signal. It should mute bond volatility, which could be, together with the dollar breaking out would be risk-off. Maybe it doesn't have any impact on credit spreads. Maybe it doesn't have any impact on currency volatility. So there's a case that this could be positive. And if so, we would position for that. There's also a case that this is going to have spillover effects that could be negative. And to the extent that outcome presents itself, we would be in a position to take risk down, commensurately. So for me, a lot of these sessions wrap up with the conclusion, good thing that we, have adaptive risk management. The only thing I would add to that is it makes sense to, blend some of the adaptive risk management signals. Some are very, zoomed in, are going to be the most sensitive to changes. Others are a little bit more zoomed out that require further accumulation of evidence. And if anytime we get a signal change, we don't know whether, what's going to happen next. So the best thing for a client would be to blend those signals. And, that leads to more of an incremental adjustment rather than, a big quantum adjustment.
Gentlemen, thank you for your insights. This was a little extended version, but we had this news announcement and earnings season recapping, and sounds like we need to wait and see a little bit to see if there's what the next move is from these big players, and then we'll use our adaptive risk management to adjust accordingly. But something to look forward to for September's Market Insights update.
Sounds good.
Okay, have a great day, everyone.
All right, good to see you, Matt. Goodbye, everyone.
Yep. Same, Rich.
Take care.